output, all that market is expecting from the war in West Asia and on inflation with Rohit Srivastava, founder and market strategist, IndiaCharts.com, who joins us this morning. Good morning, Rohit. Pleasure having you here back with us on News 9. 4 or 5 things that markets are very, very keenly watching right now. First up, of course, is the 8 p.m. deadline Eastern time tonight. That's early morning tomorrow, on whether there's going to be escalation or potentially a deadlock in West Asia. And perhaps one of the outlining sort of impact points of that could be the oil prices. Will they stabilize in the $90 to $100 range? And then, of course, the all-important RBI commentary after the MPC concludes its deliberations tomorrow morning with Governor Sanjay Malhotra. His forecast on inflation growth and interest rates. And finally, come another 10 days or so, the heavy corporate earnings season. Is there anything else which is weighing down on markets, or this is already a handful?
Oh, definitely, it's a handful. I mean, there's so many things happening all at the same time, and many of them connect back to the events that are happening in West Asia, as you mentioned, the conflict until it really de-escalates. I think the markets will continue to feel that stress. But what we are also witnessing technically is that the markets became very, very oversold into the late part of March or early April, and are attempting to make some kind of a rebound bounce back from those oversold conditions. Is the bounce really complete? We wouldn't think so. We think that it looks like markets do want to go higher. They are done with a lot of the selling on the current news flow. And unless you actually see things get worse from here, there would be an attempt for a recovery. Whether it becomes only a bounce or whether it converts into a meaningful recovery would, of course, depend a lot on the unfolding geopolitical situation. But the momentum on the downside is definitely waned. We are seeing stocks not making new lows. We are seeing indices trying to hold up much better. And I think that's a positive sign, at least from the market, because markets sometimes discount events in advance. And so we may have, discounted the worst part of the war the way we know it so far. Unless some new trigger makes things worse, we've probably discounted this aspect. And what they're really waiting for is some kind of a resolution process to start.
All right, so resolution process, well, one doesn't really know how far that resolution is from where we stand right now. But overall, the kind of disruptions that we've seen in the month of March are bound to have a negative impact on the fourth quarter earnings for corporate India, given the higher crude prices, at least as far as the energy pack is concerned. Quarter four is likely to be not in line with what the expectations were at the start of the year.
Yeah, but that's how markets are. Markets are a forward discounting mechanism. And once we know the news, the markets have sold off in March in a pretty big way. And I think to the extent that those earnings downgrades will come in, the markets would have already anticipated that. So sometimes an oversold market can bounce back even into bad or weakening earnings, because what you start thinking about is not this quarter, but you start thinking about the next 2 quarters down the line. Would things really improve? So I think that is more relevant than what is going to happen in this quarter's earnings. I think is mostly known, and that is not what markets would react so much to, is what I think.
Right. And what is your sort of outlook for potentially the RBI's outlook, which is likely to be announced tomorrow, while the broad consensus right now seems to be that RBI is not going to jump into a hawkish mode of increasing interest rates. But that commentary which comes from Governor Sanjay Malhotra is going to be very important, given, of course, all that we are hearing from across the world, given Moody's downgrade of India's growth from 6.8% to 6%, given what we are hearing from JP Morgan Chase CEO Jamie Dimon of higher inflation and potentially higher interest rates, higher than what has been anticipated so far. And then, of course, India's own inflationary concerns by way of rising oil prices, which will eventually get passed on to consumers, especially after the election season begins to ebb. What are you expecting from Governor Sanjay Malhotra tomorrow?
So, markets never move, on good news, bad news, the way we want to think about it. Usually the news is very good when markets are at the top, and news is quite bad when it's at the bottom. Having said that, the RBI would very well be supportive of markets. I think if you see if they see the current scenario as temporary, just like the US Fed did, some time back, then essentially what you're looking at is them holding back on raising rates just because oil prices have moved up, because this is not an across-the-board inflationary scenario so far. If that does happen, then of course they would be forced to move by raising rates. But right now, if it's going to only be because of the war or because oil prices have moved up, that in fact creates the opposite situation. What they really need to do is continue to provide liquidity. You have seen bond yields spike partly because they had to intervene on the currency side. So they would have to do something to keep bond yields from continuing to rise. Open market operations have been taken in again and again since December, and that I think is a process that will continue. So providing liquidity and keeping financials easy is what the RBI's role is really going to be, and not really tightening is my thought about it. Eventually, post these events, if you look back, whether it's the pandemic or it's any historical war, once you're past that point, governments always step in to support the economy with additional stimulus measures. And that's where the RBI would play a role in cutting rates, not now, but once these events are behind us. So I think we'll have to think much more ahead than actually get stuck in where we are right now.
Okay. And how dependent are Indian markets going to be on FII inflows, which should at some point begin to trickle back in? Because the retail investors will be able to hold on levels only this far. Beyond that, I think the dependence on FIIs making a comeback into India is going to be very important. But what are going to be some of those critical factors which the RBI or the government, either by way of monetary policy or fiscal policy, will have to ensure to make sure that FIIs do make a comeback?
Well, FIs haven't made a comeback in 10 years, so I'm not sure this discussion will keep coming up. The only reason FIs are not coming into India in a big way is the tax, the long-term tax, or what they call as withholding tax. I think that is the primary reason. As long as that remains, I don't expect a big flow. But as and when markets have recovered, we have seen their numbers turn slightly positive from time to time, and that's what will end up happening, which means they'll be chasing the market rather than setting the market. The market setting right now is clearly being done by domestic flows, and that is going to remain the main point. I think more important than the cash market flows is how they are positioned in the futures market, where index futures, FIs have the largest short position on record into this war. And any kind of positive trigger would actually force them to go into short covering. That's I think the big thing out there to watch out for. And right now, they're probably continuing to hold on to those shorts because so much has not yet changed on the ground level.
All right, let's leave it at that for this morning. Rohit Srivastava, as always, pleasure having you here with us on News 9, and thank you so much for your time.
Thank you.